Hello, I'm called Jingo Nelly, and I'm going to be taking you through another part of partnership. And for today, we're going to still be looking at dissolution, but for a case of insolvent partners. So before I begin off, I'm going to require you to subscribe and also follow what I'm pointing at, because I'm already having laid down information. So it is saying sometimes a partner may be insolvent, that is being unable to bring in the amount required to cover his or her debit capital account balance. So the solvent partners will have to share his or her deficiency at an agreed ratio. If the partnership agreement is silent as to how the deficiency will be shared, the Ghana vs. Maori rule will apply. So this rule states that in case of any insolvent partner, his or her deficiency should be shared by the solvent partners in the ratio of their last capital account balances. In the case of Ghana vs. Maori, facts are Ghana, Maori and Wilkins entered in a partnership under a parole agreement to contribute capital in certain equal shares. On dissolution, Wilkins was insolvent, unable to contribute anything. The effect of Mr. Justice Joyce's decision was that the deficiency of Wilkins, which was £635, should be shared by all the solvent partners in the ratio of their last capital account balances. So criticism of the rule is that it does not apply when the firm is having only two partners. Then it considers only the book capitals of the partners, ignoring the private assets of the solvent partner. So here, if a partner contributed more capital than that of the other partners, he or she will have to bear more burden than the other partners who had contributed less capital. So now I'm having an example, and it's saying Mary, Rita, and Sharon have been in partnership for the past years, sharing profits in the ratio of 2:1 respectively. On 31st December 1998, they decided to dissolve the partnership. On that date, their balance sheet was as follows. So this is the balance sheet for Mary, Rita, and Sharon. And they're having non-current assets as land and buildings having 8.5 M, then motor vehicles having 15 M, giving me a total of 23.5 million. Then I'm having the current assets, which is having inventory of 8.5 M. Then accounts receivable, which is giving me 4.5 M, giving me a total of 13 M. So the total assets, it's giving me 36.5 million. Then I come to the capital or equity and liabilities. I'm having the capital accounts of Mary, Rita, Sharon, whereby Mary is having 10 M, Rita is having 5 M, Sharon is having 1 M, giving me a total of 16 M. Then with the liabilities, I'm having accounts payable, which is giving me 15 M. Then bank is giving me 5, which is having 5.5 M. So here this total gives me 20.5 M. So the total equity or total capital and liabilities is 36.5 M. So this is the question, and it's saying the assets of the firm were realized as follows, whereby land and buildings were taken by Mary at a valuation of 5 M. 2 motor vehicles were taken by Mary and Rita at 6 M and 5 M respectively. Inventory was sold at 7 M and paid by check. Then accounts receivable were factored to Sauda at 3.5 M. Then Sharon is insolvent and unable to contribute anything towards his deficiency. So they are saying required prepare the necessary ledger accounts, including realization account, partners capital account, and then the bank account. So with this question, what you should always do, you should always once you're dealing with realization, you should always open up the realization account to make sure that you close off all the assets that are in the question. So that is one thing that you should always do with this when you're dealing with realization, and you should make sure that you know all the accounting entries. Make sure you hit back on the previous videos whereby I was introducing this dissolution, so that you can equip yourself with the accounting entries. So looking at one of the entries, which is saying on dissolution, open a realization account and close all assets except the cash and bank. So this is what I'm going to do. I'm going to debit the realization account, and then I credit the individual assets account. So this is for accounting entry number 1 from the previous video, whereby I'm going to come in my question. I look at my assets, which is a land and building, motor vehicles. I'm having inventory, and then the accounts receivable. So I'm going to create T accounts for all these. After creating them, then I get to know all my assets are going to be having a normal debit balance brought down. So for buildings, it's going to be 8.5, motor vehicles 15M, and then inventory 8.5, then accounts receivable 4.5. So after knowing that, they've said I close it off to the realization account. So I go on the opposite side and I say realization account by 8.5, so that I can balance, and I get 8.5. Then also this side, realization account 15M, this side realization account 8.5, also this side realization account 4.5, so that I can balance off this accounts to make sure that I have closed them off. Then me, after doing this, that's when I go to my realization account. I make sure I first draw up my realization account before drawing these T accounts. I draw my realization account, give it the debit and the credit. So on my realization account, remember from my entry here, they said debit the realization account. So on the debit side of the realization account, I'm going to put there land and buildings of 8.5, motor vehicles of 15M, inventory of 8.5, and then account receivable of 4.5. So after doing that, I go back to my question, and it's saying land and buildings were taken by Mary at valuation of 5M. So after me knowing that, I'll be having a memory of my entry number 5 from the previous video, which was saying partnership assets are taken over by the partners. What do? I debit the individual partners capital account, and then I credit the realization account. So meaning here, I'm going to make sure that I open up the partners capital account, and then I already have my realization account. So I'm going to open up the capital accounts, whereby I'm going to say Mary, Rita, and Sharon, whereby I'm going to say capital account, a debit side, credit side. Details Mary, Rita, Sharon, this is the debit side. Credit side details Mary, Rita, and Sharon. Whereby I'm going to go back in my question, and I get to know that capital accounts were having Mary 10M, this 5M, Sharon 1M. So you remember, with the capital accounts, they're having a normal credit balance brought down. So with this normal credit balance brought down, Mary having 10M, Rita having 5M, Sharon having 1M. After me doing that, now I've created my capital account. Remember, in the question it's saying the land and buildings were taken by Mary, and I already know from my entry number 5, it's saying debit the individual capital account. So I'm going to debit the individual capital account of what? Of Mary by the 5M, which I'm going to do here. I'm going to say realization. I debit on Mary's Mary's column. I'm going to say realization of land and building 5 million, and then I credit the realization account. So I go on the realization account, which I already drew up, which was so I get to name this capital account, whereby I get to name Mary land and building. It was taken by Mary. So on the credit side, which is 5M, then I come back, they're saying 2 motor vehicles were taken by Mary and Rita. So again, I'm going to do the same thing, whereby it's having 6 million and 5M respectively, meaning Mary took 6M and Rita took the motor vehicle for 5M. So meaning that I'm going to debit my capital account. So I'm going to go on the debit side of the capital account, and I say Mary took 6M, took it for 6M, the motor vehicle 6M, and Rita took it for 5M. And then I go on the credit side of my realization account, and I say Mary and Rita, 6M, that is with Mary and Rita, 5M with Rita. So meaning that I must always know my entries. So make sure you grasp these entries from the previous videos. So after me knowing that, I go back again to my question. Now it's saying inventory was sold at 7 million and paid by check. So after me knowing that, I memorize another entry number 8, which was saying assets are sold for cash. So I'm going to debit bank or cash account, and then I credit the realization account. Now for this question, I'm only having bank, I'm not having cash. So I'm going to, it's saying debit bank. So I'm going to, this is when I open up the bank account. So the bank debit credit, and then I say what's happening in the question. I'm having bank on the liability side, meaning this is a bank overdraft, and with bank overdraft it's going to be having a normal credit balance brought down. So I'm going to say balance brought down of 5.5 M, which is going to be this. So me, after knowing this, what does the entry require me to do? The entry, it is saying assets are sold for cash, debit the bank. Now this time around we're having only bank, debit bank account, and then credit realization account. So here the assets are being sold, so this inventory is sold. So I'm going to go on the debit side, and I debit the bank. I'm going to go on the debit side of bank, and then I put the inventory of 7M, and then I'm going to go on the realization account on the credit side, and I put there. So here I'm going to say bank, and on the credit side of realization I'm going to put the inventory. Then another transaction here, which is saying account receivable were factored to Sauda at shillings 3.5, meaning these are accounts receivable are also assets. So since we are dealing with an asset, and they also say this, and they said assets are sold for cash, still I'm to follow this entry here. So I'm going to go on the bank side, on the debit side of the bank account, and I put the account receivable 3.5, and then I come to my realization account on the credit side, and I say account receivable 3.5. So with that, that's done. Then I go to this transaction, which is saying Sharon is insolvent and unable to contribute anything towards his deficiency. So after knowing the partner was insolvent, I get to know that this is done. So I go back to my balance sheet. I get to see I already dealt with this. I finished this. I also finished dealing with this. Then even bank, I finished dealing with it. Then I'm left with the accounts payable. So for accounts payable, meaning that remember this is dissolution, and I'm closing off this partnership. So meaning that I must pay off this account payable. So how am I going to pay off this account payable? I'm going to use bank. So with this, I get to recall my entry, that is entry number 6, which says external liabilities are settled when we're having sufficient cash available. And with this, we're having the cash and it's available. So I'm going to debit the individual liability account, and then I credit the bank or cash account. So with this, I'm having only the bank account. So I'm going to open up the individual liability account, which is accounts payable. And with liabilities, they are having a normal credit balance brought down. So balance brought down of 15M from the question, of 15M from the question. And then they're saying the accounts payable, it should be you should debit it with the individual liability account. So I'm going to debit this individual liability account with a bank, which is going to be of 15M to balance it off. So when I close it off, it will balance off by 15M, and then I look for the corresponding credit side, which I'll take to the bank account, whereby I'll say accounts payable, which is also 15M, meaning I'm going to deduct money from the bank account to pay off these accounts payable when I'm dissolving off, when I'm closing off this partnership. So after knowing that, it will mean I'm through with whatever detail I was given in the question. So the next thing will be balancing off different accounts. So I'll start with the realization account, whereby I'm having already this side fully covered, and also this side fully covered up to this area. I won't be having this yet, so I'll get to know once I calculate this and this, I'll find out that this side will be more. It will be having 36.5 M, and then with this side I get to know that the figure which I have gotten from this plus this plus this plus this plus this minus this, I'll get a difference of 10 million. So this 10 million, meaning that if it's on the credit side, because when the debit side is bigger than the credit side, it will mean that the partners will have a loss share. So from with the capital account, I'm having the Mary, Rita, Sharon, so they have to share this loss in the ratio of 2 to 2 to 1, whereby 2 to 2 to 1, the total is 5. So Mary, 2 out of 5 times the 10M, giving me 4M. Rita, 2 out of 5 times 10M, giving me 4M. And Sharon, 1 out of 5 times the 10M, giving me 2 million. Then I balance off this side, so these two will be equal, 36.5M, 36.5M. So after knowing that these partners had a loss share, I recall my accounting entry 10, which was saying in case of loss on realization, I'm going to debit the individual partner's capital account, and then I credit the realization account. So with this, the realization account is already credited, and then I'm going to go on the partner's capital account and I debit. I debit it with the with the loss on realization. So I go on the capital account. So on the debit side, I'm going to say loss on realization, whereby Mary got 4M, Rita 4M, Sharon 2M. So after me doing that, I get to go back to the question whereby it was saying Sharon is insolvent and unable to contribute anything towards his deficiency. So since Sharon is insolvent, you get to know that this insolvency must be cleared by at least the other two solvent partners. So you get to know that Mary and Rita are solvent, and for Sharon she is insolvent. So meaning that on the debit side, she's having 2 million, and on the credit side she's having 1M. So meaning that you're going to find out what is her deficiency. So to find out her deficiency, you're going to look for the bigger side, which is going to be the debit side, and you're going to realize the credit side is the lesser side. So the difference between the bigger side minus the lesser side, so the difference, find out the difference is going to be of 1 million. So Sharon's deficiency is going to be of what? 1 million. So it's going to be shared between Mary and Rita. So you're going to remember from the question, whereby as I was introducing, they say all the solvent partners must share this in the ratio of their last capital account balances. So this is their last capital account balances. So I must get to divide ratios from this. So Mary is having 10 and Rita is having 5M. So divide by 5M, divide by 5M, giving me a ratio of 2 to 1. So meaning I'll best use the ratios of 2 to 1, so that they can contribute something for Sharon. So Mary, 2 out of 3 times the 1M, giving me this. Rita, 1 out of 3 times the 1M, giving me this. So meaning that Mary is going to contribute this amount to Sharon's deficiency, and Rita is going to contribute this amount to Sharon's deficiency. So after doing that, I go on the debit side to show that Sharon's account is being catered by Mary and Rita to complete double entry. So Yeah, Mary, the contribution was this amount, and Rita, the contribution was this amount. When I add this and this, I realize that this side is going to be bigger. So once this side is bigger, meaning that these two solvent partners are going to be having a normal debit balance brought down. So meaning that if I told them to like create a capital account, another capital account of Mary and Rita, the amount that I will get here, it will be on the debit side once I'm beginning my capital account, meaning that I'll be having like a balance brought down of the two amounts that I would have gotten here. Now with this, I'm assuming that I have not yet gotten them. So to get them, I'm going to say Mary out of this, which is 15, which is of this amount minus the amount here. So the difference is this, and this amount here, minus this, the difference is this. So once I add this plus this, it will self-balance, and this will be equal to this, and this will be equal to this, and this I already catered for it here. Then after me knowing that, I get to recall that once a partner with a debit balance, once a partner has a debit balance, they must pay additional, they must pay an additional amount to clear his or her debit balance. So I already told you that these two partners are having a debit balance here. So once they're having a debit balance, they must bring in, they must pay an additional amount to the partnership bank account. So this amount is going to be the additional amount they're going to pay. So that's why here I'm calling it bank, and I'm taking it to the debit side, because here they're saying you're going to debit a bank account and credit the partner's capital account. And in this case, I already did it. I already credited the partner's capital account. And when I come to bank, I'm going to say capital, whereby I'm going to say Mary and Rita, and I put these two amounts here. So that's they show that they are paying an addition to the partner's bank account, meaning that they had a debit balance which they had to clear, which they had to pay off by paying an additional amount to clear that debit balance. So this is what I've done here. And after doing that, I realized that once I add this and this bank account will self-balance, and I'll get to know from there that whatever I've been doing is correct, and my bank account has self-balanced. So thank you so much for watching. Make sure you subscribe.